The dollar index has now recovered more than 2.5% from its 52-week low, and if you have a look at the charts, there are some indications which are pointing towards a breakout in the dollar index, which could of course mean a lot of factors for commodities as well as the equities asset class. We will have a look at those as well, but before that, let me just highlight what the charts are indicating on the dollar index. One is that it has corrected about 9.5% from its 52-week high, and after touching its low of about 92.93, it is now back above the 94 level to trade at a over 2-month high as well. And in the process, what has happened is that the 50-day moving average, which is the shorter term moving average that market participants look at, that has been surpassed and we have stabilized above that level as well. Interestingly, a technical analysis chart pattern called as the inverse head and shoulder has also been formed on the dollar index, with the neckline being very close to the 94 level. In case we manage to stay above the 94 level, we could see some bit of upside coming for the dollar index. The third and the last point on the charts that I want to point out, if you draw a trend line, connecting the highs, the recent highs that we have hit for the dollar index, we are very close to hitting resistance zone near the 95 level. Once we actually cross that level, we could see an accelerated up move that we could have for the dollar index as well. Remember that the dollar index has an impact on various commodities as well as equity markets across the globe, and like we saw earlier in the year, when the dollar index started correcting from 102 plus levels to below 95, there was a massive rally that we saw in world equities, especially the emerging market space as well, because the MSCI emerging market index recovered more than 40% from its 52-week low that we hit in this year itself. Not only that, it was a global phenomenon where the US markets, the European markets, along with Asian peers and Indian markets recovered about 40 to 50% each from their 52-week lows as well. However, that looks like will be challenged with the up move in the dollar index in case that happens. So let me highlight the correlation that we've had with commodities as well as equities as far as the dollar index is concerned. Starting off with the precious metal space, all three precious metals, gold, platinum as well as silver, they have a negative correlation coefficient to the tune of about minus 0.4 to minus 0.5 when you look at the 50-day correlation on a 10-year basis. Along with that, you have Brent and copper, which also have a negative correlation to the tune of minus 0.4 based on the same data that we are looking at. So in case the dollar index starts going up, we could have an inverse move that will come in for all of these commodities as well. Not only commodities, but equities also behave in an inverse manner to the dollar index, and we can see that the worst impacted in the last 10 years on a 50-day correlation basis has been Brazil, which has a negative correlation coefficient of minus 0.4, and then you have China along with Hong Kong as well, which feature in this list, 0.2 to 0.3 times negative correlation, along with the US market 0.116 times that we have seen as a negative correlation. And lastly, you have the Indian equities as well, which are negatively correlated to the tune of 0.1 times as far as the dollar index is concerned.